Hello. Welcome to this week's Private Funds Update. I'm Sandra from SmartEsq. Let me share with you what I learned this week. First, insurance companies investing in private credit face heightened scrutiny from regulators. The National Association of Insurance Commissioners has proposed significant revisions to its Financial Condition Examiner's Handbook that will fundamentally change how insurers document their private credit investments. The proposal requires insurers to maintain detailed documentation of both their investment process and their analysis when determining whether privately rated securities qualify as bonds under the principles-based bond definition. This is crucial because it affects how these investments are classified on Schedule D for regulatory capital purposes. The NAIC is making clear that obtaining a credit rating, even with a comprehensive rationale report, is not sufficient on its own. Insurers must now document their own substantive review of legal documentation, particularly for innovative structures like rated note feeder funds, collateralized fund obligations, and bespoke asset-backed securities. The comment period closes November 13th, with adoption expected at the examiner's Handbook Group's November 20th meeting. Insurance investors should begin implementing robust documentation processes immediately, including written investment memos at the time of investment. Next, in significant ERISA news, a federal district court has ruled that a private equity fund itself, but not its general partner or management company, can be held liable for a portfolio company's pension withdrawal liability. This ruling creates a critical distinction in liability allocation within fund structures. While the fund entity faces exposure, the corporate governance separating the GP and management company from the fund provided protection in this case. Fund managers should review their structural arrangements and consider the implications for funds holding portfolio companies with defined benefit pension obligations. Turning to Europe, the European Securities and Markets Authority has issued its final report on loan fund structures under the revised Alternative Investment Fund Managers Directive, known as AIFMD2. ESMA's guidance clarifies structural requirements for loan origination funds across the EU, addressing long-standing questions about permissible activities and organizational requirements. Managers operating loan funds in Europe should carefully review these final rules, as they will significantly impact fund formation and ongoing compliance obligations. From the United Kingdom, we have two important regulatory developments. First, the Financial Conduct Authority has published final rules redefining capital requirements for FCA investment firms. These rules will affect how investment firms calculate and maintain regulatory capital, with implications for private fund managers operating in the UK. Second, the FCA has launched a consultation on fund tokenization, a forward-looking initiative examining how distributed ledger technology and blockchain could be applied to fund structures. This consultation signals the FCA's interest in modernizing fund administration through digital assets. The consultation represents the UK's effort to position itself as a hub for financial technology innovation while maintaining appropriate investor protections. That's it for this week. You can learn more about these topics from me on the SmartEsq platform. If you are curious about the services we offer, please visit www.smartesq.ii.